All right, now we have handout 2. Handout 2 is going to be adjusting journal entries. So on December 31st of this year, the company has to record some adjusting journal entries to make sure that their accounts are the balances that they should be. So we have things that happened during the year, and then we also have this additional information. We're going to start with these, and then we'll go back to the dates. So number 1 says, property taxes are due on December 1st, 2020. The company has not yet paid or recorded its $4,000 property taxes for 2020. So the journal entry for that is going to be a debit to property tax expense for $4,000. And they say here that they have not paid it yet. So we're not going to credit cash, but we are going to credit property tax payable for $4,000. So we're debiting our expense and we're crediting our liability. Number 2 says the $500 December utility bill has not been recorded or paid. So kind of the same idea. We are going to debit our utilities expense for $500, and we haven't paid it yet, so we're going to credit utilities payable for $500. Moving on to number 3, salaries accrued but not paid for $1,200. So the employees have worked, but we haven't paid them yet. So we've accrued the expense, but are not ready to pay them. We're not going to pay our cash. Same idea. We're going to debit our salaries expense for $1,200, and we're going to credit salaries payable for $1,200. Now, number 4, the office supplies account had a balance of $300 on January 1st, 2020. A physical count on December 31st, 2020 showed $150 of office supplies on hand. So in the beginning of the year, we have $300. During the year, which we have up here, let's see if we bought any office supplies. We bought $600 worth of office supplies. And then at the end of the year, we only had $150 left. So the adjusting journal entry for that is going to be how much we've used. If we had a certain balance at the beginning of the year and bought some during the year, and then also had a different balance at the end of the year, there's an adjusting journal we have to make for the supplies used. So first, let's figure out that number, and then we'll do the entry. So if our beginning balance was 300, our purchases were 600. We need to add those in because that's adding to our supplies. And then we have an ending balance of 150. And so we need to subtract that to figure out how much of this we've used. It's going to be 750. So if we're looking at our supplies account right now, there's $900 worth of supplies in our account. But we did a physical count at the end of the year and we only have 150. So we need to expense what we haven't used and take it out of our supplies account. So that journal entry is going to be a debit to supplies expense for the amount that we used, 750, and a credit to supplies because we no longer have those supplies. We use them for $750. On January 1st, 2012, the buildings account and equipment account had balances of $200,000 and $130,000 respectively. The buildings are expected to have a $16,000 salvage value, while the equipment is expected to have a $4,000 salvage value at the end of their respective lives. They are being depreciated using the straight line method over 20 and 10 years respectively. So the adjusting journal entry for a depreciation is going to be a debit to depreciation expense and a credit to accumulated depreciation. But first we need to figure out what these amounts are. So we'll break it down by building and equipment, and then we'll figure out what the journal entry is from there. So first we have the building. And our equipment. So first we need to take care of the building. Our building is worth $200,000. And when we calculate depreciation, we do not include our salvage value. So we need to take that amount out, which they said is $16,000. And so from there, we will have to depreciate $184,000 over the 20 years. And they say they're using straight line method. So we can just divide this $184,000 by 20 to calculate how much we should be depreciating each year. And that amount is $9,200. And now for the equipment, they tell us that it is worth $130,000 with a $4,000 salvage value over 10 years. So we have $130,000 minus $4,000. And that gives us $126,000 divided by 10 years, which means each year we'll be depreciating $12,600. So depreciation expense is one account. So when we debit our depreciation expense, we can basically include both of these numbers. But with accumulated depreciation, they need to be broken out by each long-term asset. So we'll have to do those separately. So our adjusting journal entry at the end of the year for our depreciation is going to be our depreciation expense. And we'll calculate this number in a second. And we're going to do accumulated depreciation for first our building, and then also accumulated depreciation for our equipment. So let's move this over a little bit. So our building accumulated depreciation is going to be $9,200, and our equipment is going to be $12,600. And in order for our debit and credit to balance, we need to add these two numbers to get what our depreciation expense is. So when we add these two numbers together, we're going to get $21,800. And that's the journal entry for that. Moving on to number 6, income tax of $7,500 for 2020 is payable on March 15th of 2021. So they're saying that they have an expense that they've incurred, but they're not going to be paying it until the next year. So just like number 1, 2, and 3, we're going to debit income tax expense for $7,500, and we're going to credit income tax payable for $7,500. So now that we've taken care of 1 through 6, let's go back up and take care of these. So January 25th, we already included in our supplies adjusting journal entry when we did number 4. So we don't have to worry about this one. So we'll start with February 1st. On February 1st, they rented a warehouse from Alpha Company, paying 1 year's rent of $4,800 in advance. They recorded the $4,800 payment as rent expense. So let's talk about what they recorded on February 1st and what they do need to record on December 31st as their adjusting journal entry. So on February 1st, this is not the answer, it's just to show you what they did. So they debited rent expense and then credited cash for $4,800. It's okay that they did that, but it's causing us to do an unusual adjusting journal entry because they expensed all of their rent, even though it was paid in advance. So what we need to do, because they bought it on, or they paid for it on February 1st, they haven't used that 1 year of rent yet. They still have 1 more month on December 31st that they have waiting for them for the month of January for the next year. So we need to unexpense 1 month of that rent expense account and put it into a prepaid rent account. So this is what Professor Weiss calls an unusual adjusting journal entry. So on December 31st, and this is going to be your answer, you need to debit prepaid rent and you need to credit your rent expense. And let's figure out what that number is. If they paid $4,800 for 1 year's worth of rent, we're going to divide that number by 12 to see how much it would be each month. And we can say that that's $400 per month. And since we are adjusting for just 1 month, because from February 1st to December 31st, they used 11 months already. So that can stay in the expense account. But that 1 month that they haven't used, we need to put that into prepaid rent and unexpense what they didn't use in 2020. So we're going to debit prepaid rent for $400 and credit rent expense for $400. Now, March 1st, they borrowed $20,000 from the bank, signing a 1-year note at an annual interest rate of 12%. So our adjusting journal entry for interest is going to be a debit to interest expense and a credit to interest payable, because we're not going to pay the interest back until we pay the note back. But we do need to calculate what that interest was for the year of 2020. So this is going to be March 1st. Yeah. So your March 1st answer is a debit to interest expense and a credit to interest payable. And now let's calculate how much interest they've incurred. So the note is $20,000 and it's at a 12% interest rate. And our interest rate is an annual interest rate. So we need to multiply that by how many months have happened. So if it's on March 1st and we're doing an adjusting journal entry for December 31st, it's been 10 months. So we're going to multiply that by 10 out of 12. So the interest that we have is going to be $2,000. So we're going to debit our interest expense for $2,000 and credit our interest payable for $2,000. Okay, so May 1st, we purchased office equipment for $30,000, paying $6,000 down and signing a 2-year, 12% annual rate note payable for the balance. The office equipment is expected to have a useful life of 10 years and a salvage value of $3,000. Straight line depreciation is used. So there's a lot of things going on in this problem. We bought equipment, we paid down a little bit of money, but we also got a note for the balance that we have due. And then also we need to depreciate the equipment. So first we'll take care of the adjusting journal entry for the interest that we've incurred on the note, and then also we'll take care of the depreciation that needs to happen at the end of the year. So on our note, it's not going to be $30,000 because we paid down $6,000 of that note. So the balance is going to be $30,000 minus $6,000, which is $24,000. And they tell us that our annual rate is 12%. And since it happened on May 1st, 8 months of interest has been incurred, not the whole year. So May 1st, let's calculate our number first. We have 24,000, which is our 30,000, minus our 6,000, times our annual interest rate, times 8 out of the 12 months. May to December, May 1st to December 31st is 8 months. And that amount is going to be $19.20. So for our interest, we have a debit to interest expense for $19.20. And again, we're not going to pay the interest until we pay the note back. And so we need to increase our payable for now. So a debit to interest payable for $19.20. Now our depreciation, we're going to use the full value of the equipment for $30,000. And we have a salvage value of $3,000 and a useful life of 10 years. And they tell us again that they use straight line. So let's figure out what this number is, and then we'll do the journal entry. So 30,000, we're going to take out our salvage value. So we should be depreciating 27,000 over its 10-year useful life. And they say we use straight line. So we're going to divide that by 10. So we should be doing 2,700 per year. But they got the equipment on May 1st, so they should not be depreciating a full year of equipment. So we also need to multiply this by 8 out of 12, and we'll get 1,800 for this year. So that is going to be a debit to depreciation expense for 1,800 and a credit to accumulated depreciation for 1,800. So it's really important to look at when the equipment was purchased or when the note started, because you want to make sure that you're not calculating a full year when you really should be doing 8 out of the 12 months. Okay, moving on to July 1st, we purchased a 3-year comprehensive insurance policy for $1,200. So on July 1st, we bought it, and now it's December 31st, and we need to think about what kind of adjusting journal entry we need to do for that. So July 1st, we bought an insurance policy, and now we've used 6 months of that insurance policy. So when we bought it in those 3 years, for those 3 years, we debited our prepaid insurance and credited cash because we paid for it. And so now we've used 6 months of it. So we need to lower our prepaid insurance account and debit our insurance expense. So we're going to debit insurance expense, and we're going to credit prepaid insurance. And let's calculate what that number is supposed to be. So if they bought an insurance policy for $1,200 for 3 years, let's divide that number by 3 to figure out how much they should be expensing every year. It's going to be $400, but they bought it on July 1st. They've only used 6 months of it. And so we're going to multiply this by 6 out of 12. And so this adjusting journal entry will only be for $200. Moving on to August 1st, sold land for $18,000 The purchaser made a $6,000 down payment and signed a 1-year 10% note for the balance. Interest and principal will be collected on the maturity date. So now we're the seller. We sold land. The adjusting journal entry has to do with the interest that we are owed. So let's calculate what that's going to be. The note that we issued them was not for $18,000 because they made a $6,000 down payment. It's going to be for $12,000. So a $12,000 note, and our interest rate is 10%. So we're going to multiply that by 10%. And if this note was issued on August 1st, then we've incurred 5 months of interest. So we're going to multiply that by 5 out of 12. So right now on December 31st, they owe us $500 worth of interest. So August 1st, it's going to be interest receivable because we're not receiving it until they pay back the full note in a year. And we're going to credit interest revenue, both for $500. So we're receiving this, we're waiting to receive this. This is like an AR account, and we've earned this revenue. So we're going to credit interest revenue. Now, October 1st, we rented a portion of the retail floor space to a florist for $300 per month, collecting 8 months rent in advance. We recorded the $2,400 receipt as rent revenue. So on October 1st, when we got this $2,400, we debited rent revenue. No, we credited rent revenue and we debited cash. But they paid in advance. We haven't really earned this yet. We're going to leave it as is, but on December 31st, we need to do an adjusting journal entry to take out what hasn't been earned from our rent revenue account and put it into our unearned rent revenue account. So if they gave us 8 months of rent in advance, and from October 1st to December 31st, we've only earned 3 months of it, then we need to take out the other 5 months and put it into our unearned revenue account. So October 1st, we need to debit rent revenue because this is going to lower that account. And we're going to credit unearned rent revenue to increase that account because we haven't really earned 5 months of that rent yet. And let's calculate what that number is going to be. So if they gave us $2,400 for 8 months, like they told us, it's $300 per month. And so we need to take out 5 months of this rent. So we're going to multiply this number by 5. So that means we need to take out $1,500 from rent revenue and put it into our unearned rent revenue. This is also an adjusting journal entry, or an unusual adjusting journal entry. So there you have it. You have all of your AJEs for December 31st.